In a recent video, we looked at what defines a partnership, the different types of partnerships, and the different types of partners. In this video, we look at what types of income partners can receive from partnerships. I'm the Tax Geek, and here is partnership income, oversimplified. You can take a look at that previous video by clicking the card above or the link in the video description. Income from partnerships falls into three broad categories: ordinary business income from the partnership, guaranteed payments from the partnership, and what are called separately stated items. All of these items are reported on a partner's Schedule K1. K1s are also covered in their own separate video. The most common type of income a partner can receive is ordinary income from the operations of the business. This is the operating revenue of the business minus the operating expenses of the business, with some exceptions that we'll look at later. This net ordinary income is then divided among the partners according to their partnership agreement. Since the partnership doesn't pay taxes on this ordinary business income, the partners pay taxes on their shares of the income at their ordinary marginal income tax rates. Since marginal tax rates can vary from partner to partner, partners can pay different amounts of tax on the same amount of partnership income. For example, Adam and Beverly are business partners, and they each had ordinary income from the partnership of $35,000. Adam's sole source of income was the $35,000 from the partnership, while Beverly had additional income from wages of $72,000. Adam's marginal tax rate is 12%, while Beverly's additional income pushes her into the 22% marginal tax rate. Thus, Adam will pay less tax than Beverly on the same amount of partnership income. If the partners actively participate in the partnership, this ordinary income is also subject to self-employment tax, which itself may vary depending on the amount of earned income the partners may have. This is because partners with higher earned incomes may exceed the maximum income subject to Social Security tax. A partner may also have income from guaranteed payments. These are payments to the partners that are stipulated in the partnership agreement and are not tied to any ordinary income or losses the partnership may incur. Guaranteed payments are an operating expense of the partnership and are subtracted from partnership revenue along with most other partnership expenses to arrive at ordinary partnership income. Guaranteed payments are reported on line 10 of Form 1065. Merely receiving cash or property distributions from a partnership is not a guaranteed payment. The payment must be specified in the partnership agreement and must be paid to the partner, even if it creates a loss for the partnership. Guaranteed payments are not considered to be salaries and are not reported to the partner on either Form W-2 or Form 1099. Instead, they are shown in boxes 4A and 4B of the partner's Schedule K1. All guaranteed payments are subject to self-employment tax. Each partner reports any guaranteed payments as income along with their share of any residual ordinary income or loss. Going back to Adam and Beverly, suppose that their partnership agreement stipulates that Adam is to receive an annual guaranteed payment of $45,000. If the ordinary income from the partnership is $15,000 after subtracting Adam's guaranteed payment, Adam would be taxed on the $45,000 guaranteed payment plus his $7,500 share of the ordinary income, totaling $52,500. Beverly would be taxed on just her $7,500 share of the ordinary income. If instead, after paying Adam his $45,000 guaranteed payment, the partnership sustained an ordinary loss of $15,000, Adam would be able to use his share of the loss to reduce the taxable income from the partnership to $37,500, while Beverly would have a $7,500 loss she could use to potentially offset other income she may have. The final category of items that can affect a partner's taxable income are known as separately stated items. These are types of partnership income, deductions, and credits that are not included in the ordinary income of the partnership and are individually passed through to each partner. They can also affect each partner's investment in the partnership or that partner's basis. Partnership basis is definitely a story for another time. Most separately stated items are shown on Schedule K of Form 1065, which is located on page 4 of the return. All of these items have corresponding lines on the partnership Schedule K1. Just like ordinary income, partnership income from interest, dividends, capital gains, or rental income can be taxed differently from partner to partner, depending on what other income the partner may have. Going back to our original example, let's say Adam and Beverly's partnership had investments which generated $600 in qualified dividends. Since Adam's marginal tax rate is 12%, his $300 share of the dividends would most likely be taxed at 0%. Beverly's 22% marginal tax rate would most likely mean that her share of the dividends would be taxed at 15%. Likewise, certain partnership expenses are passed through to each partner. Deductions such as a Section 179 deduction or charitable contributions are claimed directly by each partner because the tax benefits of these deductions can vary from partner to partner. Again, let's suppose that Adam and Beverly made a $1,000 donation to the American Red Cross in the name of their business. This donation would not be reflected in the partnership's ordinary income. Instead, Adam and Beverly would each claim a $500 charitable contribution deduction on Schedule A, assuming they would otherwise be able to itemize deductions. Adam's 12% marginal tax rate could produce a $60 tax savings, and Beverly's 22% marginal tax rate a $110 tax savings. And finally, businesses may be able to qualify for any of a large number of tax credits for making certain investments or hiring certain types of employees. Since partnerships don't pay taxes, these credits are divided among the partners and taken on their individual returns. As complex as many aspects of partnership income can be, most modern tax software, both consumer and professional, will automatically calculate the correct tax and file the correct forms based on accurate input of information from the partner's K-1. Additional information and resources on partnership income are linked in the video description. Please like the video if you found it informative and share it with anyone else who could find it useful. The best way to see more videos like this one is to subscribe to the channel. And of course, your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of Your Taxes Oversimplified.